Let's go to Brian Chung, who is in our D.C. bureau. He, of course, at the press conference, getting in a question to the Fed chair there. But, Brian, let's first talk about the repo market. I think by my count, there were at least 5 questions from your peers there in the press conference asked about the repo market. I thought it was very interesting. Powell's stance was pretty clear. I'm not worried, and you shouldn't worry either.
That's exactly it. And actually, I wanted to make it a 6th question about the repo market, but I figured he was probably exhausted from all that, so I threw in a very in-the-weeds question about treasuries instead. But yes, I mean, that seemed to be...
declined to answer, by the way.
Which he declined, right. I tried my best anyway. He was maybe tired by the end of that conference anyway. But as you mentioned, repos, I mean, really in focus here. It was actually among the first few questions simply because of all the liquidity crunches that we saw yesterday and also on Monday night that actually ended up pushing overnight borrowing rates for some borrowers as high as 10%. It ended up pushing the federal funds rate, the effective federal funds rate, above the Fed's target. I believe we have a graphic that you can actually see, the federal funds rate actually breaching where the Fed's current rate, or rather previous range now, was. Keep in mind that before this afternoon, the federal funds rate target was between 2 to 2.25%. And what we saw was that the actual effective federal funds rate actually reached 2.3% as of yesterday, which would kind of tell you maybe the Fed is losing control of its interest rate policy. So this all has to do with what I mentioned as the overnight repo market. This is the market where banks and broker-dealers lend to one another in very, very short-term contracts, agreements, basically overnight, just to get cash so that they can finance the securities like treasuries that they have on their balance sheet at that time. This is really the plumbing of the financial system. But what Jay Powell was saying was that this actually has nothing to do with inflation or unemployment or the labor market, as the Fed's dual mandate actually is. And he said, quote, "They have no implications for the economy or the stance of monetary policy. So translation, don't need to worry about it." And the actual mechanics of this have kind of been the same case in terms of what Wall Street thinks of this whole episode as well, which is that this really had to do with kind of the timing of these corporate tax payments in addition to the new issuance and auction of new U.S. Treasuries, which appears to be a temporary thing, at least through September. So if the Fed can weather it through September, well, then the counterfactual is pretty clear. If they get through that and there's no more issues in the repo market, well, then this truly was just a temporary issue that isn't necessarily telling of bank reserves being severely kind of capped in the current balance sheet framework that the Fed is operating at the moment. So Chairman Powell is saying, hey, look, no time to panic for right now.
Yeah, temporary, but also ongoing, because a little bit of breaking news. We just got today's statement regarding repurchase operations for tomorrow. It's going to be another $75 billion auction tomorrow. There was 75 today, of course, which was oversubscribed by $5 billion. And it's going to be at 30 basis points lower, similar with what happened with IOER. It will be at the minimum bid rate will be at 1.80%. So kind of expected there, but definitely ongoing, this situation.
Yeah, and I mean, you mentioned the open market operations. This is being run by the New York Fed. And for those of you that were kind of wondering what was going on with the New York Fed yesterday in the morning, what happened was that in order to address the liquidity crunch, the New York Fed decided it was going to step in directly, which it has the authority to do, to offer its own repo facility to markets to alleviate some of the cost pressure that we saw from the spike in interest rates. So what they call the TOMO process, this type of temporary process that they have, it's really a way for them to alleviate some of that pain. And it was interesting to see that on Tuesday morning, they opened it up also for $75 billion, but at the time, only about $53 billion in agreements were actually taken up by the market. When the Fed decided to reopen the same facility this morning, they again, $75 billion, but they hit right up against that cap, as you mentioned. So this is something that we expect to continue through the rest of at least this month because of the pressures that we see from those corporate tax payments in addition to the Treasury auctions. These are pressures that will continue to exist through the rest of this month because the Treasury needs to fill its what they call the general account during that time as well. So, this is something that the New York Fed is going to have to continue to open, and hopefully they've gotten over the technical issues that they had yesterday. Keep in mind that they actually had to delay the opening of this facility by about 20 minutes because this is something that they have not done in about 10 years. So I guess they had to blow the cobwebs off or the dust off of the cartridges to get that thing back up and running yesterday. So kind of interesting to watch. But Jay Powell, keep in mind, the Fed has a number of different tools that they could use to address this. One example is what they call a standing, repo facility. This is something that would actually exist at all times, because right now what the New York Fed is doing is they're opening it up for only a certain amount of time each morning. A standing repo facility that kind of exists at all times would be able to serve the real-time needs of the repo facility, of the repo market if it needed it. That's something that the Fed kind of wants more time to figure out because there's a lot of technical challenges. As we saw, even the New York Fed couldn't get its thing started up yesterday. Another way that they could address this would be by using the balance sheet and actually allowing it to grow further. Some say that maybe the balance sheet was actually too restrictive at the point that it decided to stop at $3.8 trillion when it abruptly ended it in July. People are saying maybe that didn't leave enough bank reserves in the system, so should the Fed continue to grow its balance sheet again? Now, before everyone starts freaking out about, oh, this is quantitative easing all over again, well, it's a little bit of a matter of semantics about what you might call quantitative easing. Bank of America Merrill Lynch says maybe they might need another $250 billion in that balance sheet. Well, is that in and of itself quantitative easing, or is that organic growth? Does it depend on how quickly they end up fundraising that $250 billion? There's a lot of moving parts here. But again, no announcement on the balance sheet in today's meeting from Chairman Powell.
So, Brian, the president calling Chair Powell a terrible communicator in a tweet that came out after the decision. Seems like at least the market thinks Powell's getting a little bit better maybe at communicating during these meetings here and the press conference after. I still think it's good to have a translator, though. So I'd like you to help us do a little central bank translating. He was asked whether or not they have an easing bias.
Right.
Do they have an easing bias after sitting through that whole press conference? What do you think?
Well, actually, luckily, I don't even need to translate that. There was a direct question about whether or not there is an easing bias at the Federal Reserve, and Chairman Powell said that they really haven't used that type of terminology in quite some time. I mean, the easing bias or the bias language was kind of implemented during that period where the Fed was kind of promising or, staying at close to zero or zero interest rates at the time. They had a kind of lower for longer period that they were messaging to markets that we're going to keep it this way until things get better. This is not the case right now. And one perfect example of that is that there were 3 dissents in the decision today. That's a record under Chairman Powell. You had, and it's not just 3 dissents on one side, there are 3 dissents on completely different sides. You had James Bullard from St. Louis saying that he would have preferred 50 basis points of cuts today. Then on the other side, you had Esther George and Eric Rosengren arguing for no change at all in the policy meeting today. So for the Federal Reserve, and especially for Jay Powell, this is a serious challenge. And this is where you might want to translate what actually President Trump was saying in his tweet, which is that the communication of this Fed actually in some way has been quite confusing. But you can't necessarily fault Chairman Powell for that when you're trying to juggle the multiplicity of visions that you have on this current FOMC, when you have some people saying we need an aggressive rate cut and some saying we don't want one at all. So for your, intents and purposes, this is a really difficult time for Chairman Powell. And he actually said that during the conference. There was one answer where he said, I must admit, this is really challenging. Mm-hmm. So not necessarily that he's waving the white flag or anything, but not necessarily. It's not like Janet Yellen is looking at this press conference as being, I wish I were there right now.
Only all of us wish we were there with you.
Right.
All right, Yahoo Finance says Brian Chung live in D.C. We'll see you back here soon.
Thanks.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.